Step 2 is going to be identification of subsequent events. What is a subsequent event? Our balance sheet date, let's say, is 12/31/19. The date of my audit opinion, let's say, is going to be February 15th, 2020. So there can be events that happen in January and the first half of February that could significantly impact the information in the financial statements or the company going forward. And therefore, I might want to disclose this information in the financial statements, or it might even affect some of the information back here at the balance sheet date so that I need to adjust my financial statements. Okay, so there's two types of subsequent events. The type 1 subsequent event, which is a much bigger deal, is when you have an event happening out here. Right? So let's just say, for sake of argument, we have an event happening January 15th. So I have an event happening January 15th, which relates to something, a condition that existed before the balance sheet date, before 12/31. Because of that, it is going to affect an estimate that is part of the financial statements. This is going to require me to actually adjust the financial statements. So let's look at some examples. Example 1 would be, let's say we had a customer that goes bankrupt after the balance sheet date. So we said our example date was January 15th. So let's say my customer goes bankrupt and that is announced on January 15th, 2020. So I have $1 million from that customer sitting in my accounts receivable balance as of 12/31/19. So the idea is, I now know, long before I'm actually issuing my financial statements and issuing my opinion, which that's happening in February. So I know long before I issue my financial statements that 12/31/19 AR balance is not collectible. So it would be wrong for me to publish a set of financial statements in February that include that accounts receivable balance being recorded at 100% as if it's collectible. So what I really need to do here is add a reserve against that AR balance, basically, because I know it's not going to, assuming I know that what's happening with the bankruptcy and assuming I know none of it will be collectible, I could add a 100% reserve against the AR balance. And basically you're doing this kind of after the fact. So it's like, hey, hindsight is 2020, and you're able to correct your financial statements. Remember, the reason you're able to do this is because your financial statements and your 10K haven't been issued yet. So this is our 10K issuance date / audit opinion date. If you discovered if the company went bankrupt out in March, it would be a totally different situation. Okay? If the company went bankrupt out in March, then it's fine. You don't have to restate your financial statements or anything like that. Okay? Then you would just worry about it for next year's audit. But if you find out that they went bankrupt before you issue those financial statements, then you should not let them go out with basically an uncollectible AR balance being presented as if it were collectible. Okay, another example of a type 1 event would be if we had a lawsuit settled after the balance sheet date for an amount materially different than the contingent liability we recorded. So let's say as of 12/31, I had a lawsuit where I had the contingent liability and the litigation expense recorded at $5 million. Then on January 15th, this lawsuit settles for $10 million. And remember, the actual date of my financial statements coming out is February 15th. So the idea here is exactly the same. I now know that this $5 million balance in my financial statements is incorrect. And because I have not issued my financial statements yet, right, that doesn't happen until February, I can use my power of 2020 hindsight to fix my financial statements, right? I can fix them, I can update them, and make them basically more materially correct than they were. Because really, this $5 million was a bad estimate. And same with this AR balance. So I didn't know this company was going bankrupt until January 15th. But really, I mean, they were effectively almost bankrupt on 12/31, right? They just hadn't declared it quite yet. So basically, the fact that I had that money in AR was kind of a mistake at 12/31. Just like the fact that I estimated the $5 million at 12/31 was kind of a mistake on my part, right? It's just a bad estimate. So I'm using my power of 2020 hindsight. I can fix it because I haven't crossed this threshold yet. Now, again, if I had crossed this threshold, if I don't find out till March that the lawsuit settles for $10 million, then it's totally fine. You would not be going back and restating these financial statements. Okay, so now we're going to talk about type 2 subsequent events. Type 2 subsequent events are going to happen when we have a condition which is being discovered during this period here, which did not exist at the balance sheet date. It's not something where there's a related AR balance or a related contingent liability balance, so nothing like that. So it didn't exist as of the balance sheet date. And so therefore, whatever this event was, it's not going to affect the accuracy of my financial statements as of year end. But basically the idea is I still think it's going to be a material enough event going forward into the next fiscal year that I want to tell my shareholders about it. So what happens with an event like this is I am going to disclose it, and I might present pro forma financial statements, which I'll talk about what those are in a minute if you don't know what they are. Okay, so let's talk about some examples. A type 2 event. Okay, so an example, the kind of classic example would be, let's say I make an acquisition. Okay, so once again, 12/31, I have the financial statements. It's my fiscal year end. Then on 1/15, I make an acquisition. And my actual 10K is issued on February 15th. Like the prior page said, this acquisition does not relate to anything in the 12/31 financial statements. So it doesn't mean those financial statements are incorrect. Nothing in those financial statements is wrong. However, this acquisition is going to be really material to the company going forward, right? It's going to be important to the company going forward. So what I would want to do is go ahead and disclose to my shareholders that, hey, this is a material event that happened, right? Because I haven't actually issued my financial statements yet, so I can go ahead and tell them that this happened. And it's going to be just in an extra footnote. I can tell them it happened. So it can be footnote disclosure. And we also said I can use pro forma financial statements. So let's talk about what that would be, what that would look like. So basically in a footnote, what you can do with a pro forma financial statement is within the footnote, you would have kind of a sample balance sheet and income statement that would show, like, this is our regular 12/31/19 balance sheet and income statement as they were, plus this was the business we acquired, right? So if we had included the acquired business in with our regular business, old business, as of 12/31/19, this is what it would have looked like. Okay, so it's kind of like a combined disclosure or picture of what the company will look like in total going forward. And same with disposals. So it would be like, hey, here's what our actual financials were 12/31/19 minus the disposed, business segment or whatever. And so this is a picture of what things are really going to look like going forward. So other examples could be things like a catastrophic event, like a fire or flood. With the fire or flood, so this sometimes confuses people because they'll say, hey, that, the building that caught fire, the machines destroyed in the flood, those things were in the financial statements as of 12/31. Right? So that seems like it might be a type 1 event. But what you need to remember is as of 12/31, those machines were not damaged. They were not on fire, right? Those machines and equipment and so on were perfectly fine. So it's very different from the type 1 events where, okay, as of 12/31, this customer really was not fine. It's just that we didn't find out till January 15th that that customer was bad. This lawsuit, as of 12/31, really wasn't ever going to settle for $5 million. It's just that we made a crappy estimate and we should have known better. We should have known it was $10 million. So it's very different than the fire or flood that was kind of a completely unexpected event that came out of nowhere. Okay, so these are our audit procedures for identification of subsequent events. So we would make inquiries with management, of course. You're getting to see that's a very common theme with these concluding audit procedures. So we'll ask them, hey, are you aware of any unusual events happening? Any changes in estimates that need to happen? Any substantial contingent liabilities, etc. We would also do things like read the interim financial statements. So this, when it says interim, it means get the January, February, etc. financial statements available for the period after year end, compare those to the year end financial statements. So the idea is if they did something major, like make an acquisition, we would see that pop up in the February financial statements, right? There'd be big changes like a massive goodwill balance appears or, intangible assets comes and inflates out of nowhere. We can also look at journal entries after year end, especially non-standard JEs, which if you remember, we kind of talked about how there's non-standard or topside journal entries that occur outside of the normal GL system whenever a company has to do journal entries after the books are officially closed. And so those can often be an indicator that a subsequent event has possibly happened. We talked already about kind of reading board minutes and talking to legal counsel. So legal counsel, in terms of subsequent events, we usually get the legal letter from them relatively early on, like let's say mid-January. And then what we'll do is right before our audit opinion date. So let's say our audit opinion date is 2/15. We would get an update on the legal letter from the lawyer just a couple days before the audit opinion date. I think it's officially we need to get it at least, within a week before the audit opinion date. So that way, if something unusual has cropped up, then we would know about it. And also in terms of subsequent events, because we have subsequent events, something called a dual dating issue can crop up. And this is generally going to be more of a problem for private company audits. And the reason why is this is generally going to be a problem when there is a long lag between the audit report date and the actual issuance of the financial statements. All right, so remember the audit report date. This just represents the date of which I have officially collected all the evidence I need to issue my audit opinion. The issuance of the financial statements, they can do that right after the audit report date, or possibly they could wait another month before they issue the financial statements, because this is really up to management. Now, if we are doing a public company audit, generally you will not see a lag between the audit report date and the financial statement issuance date. The reason why is because with public companies, they have relatively strict filing deadlines, right? If you look at accelerated filers, large accelerated filers, the accelerated in that means they have to file quickly, right? They have to file within 45 days or they have to file within 60 days. So everybody is scrambling, management is scrambling, the auditors are scrambling up until the very last minute to get all the evidence that is needed to issue that opinion. So you're not going to have a lag with a public company. You're not going to have some long lag between the date the audit report is issued and the date the financial statements are issued. But in a private company audit, you certainly could have a long lag. So it could take me, I could go ahead and issue you my report, and then it could take management a while before they decide they want to actually issue the financial statements. So the dual dating issue is going to crop up if a subsequent event is discovered in this period, right? If a subsequent event is discovered after I've issued my report, but before the financial statements are issued. So for instance, if a subsequent event here was discovered on February 27th, that would create a problem, right? Because the auditor already issued their report, but now management has some subsequent event and they want to be adding some footnote to the financial statements that talks about it. So obviously this is a problem because now they're going to want me, the auditor, to be coming and looking at their financial statements again. So now what do I do, right? Do I create a whole new audit report? Is my report going to have to be dated 2/27? What's going to happen? So I actually have a couple of choices here. My second choice, which is the kind of the inferior choice here, my second choice is to date my whole report 2/27. It's kind of what I was saying on the last slide. So this is me changing the whole date of the report, changing everything to 2/27. Okay. The reason why this is the suboptimal choice for the auditor is because it extends my liability as an auditor. What it means when I say it extends my liability, it extends my legal liability for all the accounts, and it basically implies that I have done all these audit procedures for subsequent events through 2/27. And I actually, if I want to have just one report date, the 2/27, I then have to go do all these procedures through 2/27. So if they've had more board meetings, I'm going to have to read those minutes. If they've had any more journal entries, I got to look at those. I have to update my legal counsel letters again, right? Do another update because I need to make sure I have that update within a week of the opinion date. I'm going to have to look at any new interim financial statements that have been issued, so on and so forth, right? So this is not the most optimal, number two. So the other option is to dual date the report. Okay? And what that consists of is basically I'm going to say, okay, the date of this report is 2/15, right? My original report date, with the exception of footnote whatever, whatever the subsequent event. Let's say the subsequent event is discussed in footnote S for subsequent event. So I'm going to say, okay, my report is as of 2/15 with the exception of footnote S, which is as of 2/27. Okay, so that's the dual dating. It's basically there are going to be two dates in your report. The nice thing about this is it limits your liability through the date of your original report, with the exception of that one footnote or event. So that's it for dual dating. And this slide is just saying, hey, you can also have subsequent events, of course, with respect to internal control. So an example of that would be if I had thought I had perfect internal controls, right, and I was ready to conclude that internal controls were effective as of 12/31/19. And of course, same as before, my opinion is being issued 2/15. But then on 1/15, I discover something that makes me think there's a material weakness, right? So this material weakness could make me think it existed as of 12/31. It could make me think, hey, this just relates to January and will be applicable going forward. That would be kind of like a type 2. So it's very similar to the other types of subsequent events. It's just that you can also have them with respect to internal control, and you should also look for them with respect to internal control, right? So you should also be reading internal control reports and reports that are issued by management on any changes in the internal control environments.